Welcome to the Homeward Bound podcast by the Mortgage Guys, your ultimate guide to navigating home buying and mortgage lending. Whether you're searching for your first home or settling into your forever home, we're here to make the journey simple, clear, and exciting, helping you secure your dreams one home at a time.
All right, everybody, welcome to the Homeward Bound podcast. We're excited to have another episode here. We have a little bit of a special one for everybody today. We have some remote guests that are going to be coming in. And today, this is a topic we've been wanting for a long time. We're going to talk about a four-letter word, rate. In the mortgage world, it is a four-letter word. You can kind of look at it for whichever way you want to, but we're going to talk about mortgage rates. Kyle Torgeson's here with me today on the podcast as usual. And Kyle, how often do you talk about or get asked questions about rates?
You know, if I'm sure you can relate to this, but if you and I had $1 for every time that came up during our day, we would have retired a long time ago.
Yeah, exactly. Exactly.
But that's the big question. That's where everybody wants to understand. There's that big question mark in the sky, like what is going on with rates and why?
Mm-hmm.
And so we're excited to be able to have our guests with us today and introduce that and kind of dissect through that in a way that will be understandable to the regular Joe.
Yeah.
Because that's how we're trying to market and help out, right?
Yeah, exactly. Yeah, and with that, before any further ado here, let's just go ahead and introduce the guests. They're remoting in from their locations in other states than we are right now. But first off, I'll go ahead and introduce David Dysert. He is the Chief Capital Markets Officer, I believe I get that right, for Premier Mortgage Resources, who we all work for. I'm going to let him take a minute and introduce himself. And following him, we're going to introduce Matt Dunbar. And Matt Dunbar is our Chief Strategy Officer, also with Premier Mortgage Resources. So David, talk a little bit about what it is you do and what your role and responsibilities are.
Well, thank you, sir. Yes, I am the Chief Capital Markets Officer of Premier Mortgage Resources. We're an independent mortgage banker, and what I do, my role is to manage what's called secondary marketing, which is basically capital markets. It's all about managing our interest rate position. As we take in locks from our customers, we have to guarantee that rate and price in a market which is moving the rates and prices up and down. And so how we do that is we employ a very conservative and steadfast hedging model, which allows us to lock in your interest rate and guarantee that rate and price regardless of market conditions. And so my department really takes in the locks, manages that pipeline, we hedge the position, and then we sell those loans on the secondary market. That's where that term comes from. So it's a big word, but it's a pretty simple process in terms of just making sure that when you lock in a rate, we can honor that rate and price regardless of condition.
That's awesome.
I've been doing it for about 25 years. I've been through the financial crisis. I've been through COVID, all the ups and downs. It's been an interesting ride. I love it. And Premier's a great company. We've been here through COVID and beyond, and look forward to what's next. Hopefully we don't have any more major shocks like that coming, but we'll see.
Amen.
Yeah, no kidding. Well, Matt, why don't you take a second and introduce who you are and what you do?
That's a tough act to follow. My name is Matt Dunbar. I'm the Chief Strategy Officer here at PMR. Overall, my role is to really identify the markets and areas we want to grow in, where there's opportunities to serve the communities and, grow our teams, grow our product sets. All in all, it's a fairly straightforward role, but, I look for opportunity where we can serve the community and work to identify and help grow there. I've been doing this for about, not quite as long as Mr. Dysert, but 24 years now, I believe. That's a little bit about me, nothing too exciting.
Awesome. We're grateful to have him here, aren't we, Kyle?
Yeah. It's, I was just thinking as you both were speaking, we've got David Dysert, who's in Oregon. Is that correct, David?
That's right.
And then, Matt, you're in St. Louis?
Yep.
So we are a nationwide company. We're growing. It seems like every time we have a company call, they're introducing multiple markets that are being opened up. And so Premier Mortgage is expanding. It's doing wonderful in a difficult market where a lot of mortgage companies are honestly struggling.
Yeah.
And I'd say a lot of that, of course, has to do with these two individuals that are joining us, making sure that we're profitable, making sure that we're moving in the right way, and still being competitive in our markets with rates. And no, it's exciting to have you both here. We're excited to ask a few more questions and get going on this.
Yeah, it's good to have the big guns here. That's what we're going to refer to you guys as. So let's just go ahead and roll into this. I know that David, you're on a tight schedule, so let's get going. I think one of the things we get asked questions, obviously, like the last few weeks especially, hey, Fed cut the rate. So that means my mortgage rate's going to be a quarter or a half different today. So, and I know that a lot of that is based on, you talked about the MBS market. David, would you explain the MBS market to the average person, the average client, as best as you can?
Sure. Well, MBS, mortgage-backed securities, basically it's a bond. It's an IOU, right? The bond market is how everything in the world is funded. Basically, you watch the TV and it's all about stocks. The stocks are the roof of the building, maybe, or the window drapes. The bond market is the foundation of the house. MBS is a key part of that bond market. And basically, it was an innovation. Actually, Freddie Mac issued the first MBS in 1971 when yours truly was born. So it's in the scheme of things, a recent innovation. And what it does is it provides liquidity, which is the key element in any type of finance world. And what it does is we pool the mortgages up into these securities, and then that allows investors to invest in them, which replenishes the amount of money that we can lend out. Prior to the innovation, it was lending institutions really had to lend from their own banking, deposits. And so, of course, that you could see, the run on the banks. There's many funny movies about that, of course, during the holiday season. But you can see the problem with that if you're limited to what your local bank could lend. And also what MBS not only provides liquidity, it provides geographic diversity, because if your lending institution is based all in deposits from a local town where the mill closes, you could see how that could be a problem. So it diversifies, spreads out risk, and provides liquidity. It's a big innovation. It sounds complicated, but it's just an IOU that investors get to invest in and replenish the lending supply of money.
That's awesome. That was a great way to simplify that a lot. So with Dave's question about the federal funds rate, immediately my younger brother, who is very smart, called me and said, "Hey, cool, mortgage rates are 4.25 now, so let's get this refi rolling." I had to give them a brief explanation of the MBS and how that isn't necessarily tied to the 10-year. Can you talk to us about the relationship of the federal funds rate with the MBS?
Sure. The federal funds rates is the cost of lending institutions to borrow from each other. It's a key interest rate in our lending world, but it isn't. Let me step back. So the MBS that we just talked about trade most typically to a spread with the 10-year Treasury. Now, the Treasury market is made up of a yield curve of short-term Treasuries all the way up to the 30-year long bond. And so mortgages are more heavily influenced by the spread in the longer end of the curve. Now, obviously, when the Fed cuts rates, it most directly impacts the short end of the curve. But of course, that does impact the overall curve when they do that. It also, in a key way, affects the spread between MBS and the 10-year. And so if the spread narrows, that's going to lead to lower rates. So it's a very indirect relationship that the Fed has with mortgage rates, but it's a very significant relationship. So, think of car loans and credit cards. That's going to be more heavily influenced by an immediate cut. And the reason that it's confusing for consumers is they think the Fed is directly lowering rates that are tied to the mortgage rate, and they aren't. It's a complex of rates that is more of an indirect relationship. And what typically happens, of course, it's a futures market. So investors are front running the Fed. If they think the Fed is going to cut, we already had that. If you've been watching rates, you notice we had a rally ahead of the Fed cutting in anticipation of that cut. So it's not uncommon to see rates actually worsen a bit after the Fed cuts, because a lot of that is the investors are already ahead of the Fed. And we had that all through the last several years. We had the market front running the Fed and kind of getting it wrong. Mm-hmm. getting their fingers burnt by thinking the Fed was going to act before it did, because inflation's been a lot stickier and the economy has been surprisingly resilient beyond people's expectations. And so that's led to this sort of push and pull of rates vis-a-vis the Fed cutting or not cutting.
Actually, so I had an opportunity to present to a group. I have a networking group called B&I that I go to every Tuesday, going on 7 years. I can't believe it. But I had to present, and the one thing I wanted 40 more people in the world to understand is that when the Fed cuts the rate, it doesn't mean mortgages are doing so. I tried to help them understand that they're not one and the same. So that was wonderful to have your explanation on that. And if we could help people understand that it's an influence, perhaps in the market, but it's not the market.
And the word that I've always used for this is, and I think I might have learned it from you, David, I don't know, but anticipatory. Anticipation, and like you said, you guys are way ahead of the curve here as far as the people that are setting mortgage rates and a lot of this movement that you talked about, because you guys are anticipating what the Fed is going to do. Let's talk, and this is a little off the cuff question. What if, what if the experts are predicting a 0.5% cut to the federal funds rate, but then all the anticipation and the movement already happens ahead of the curve, like you mentioned, and then it only cuts a quarter? What does something like that do? What would that maybe do to the market if the cut was less than anticipated?
Well, it'd be a negative, obviously, for mortgage rates. If the market is overshooting the Fed and thinking they're going to do more than they do, you're going to have a negative reaction to that. But I want to step back 1 second, because it's not, the Fed funds rate is an important piece of the puzzle that the Fed has control over. But it's important for folks to understand how drastically different the new normal is. And we're talking about the last decade or so since the financial crisis, where you had the Fed intervention and the Fed and central banks around the world intervening in the most dramatic way that, complete in history. And by pushing rates to zero, and also when they did that, but also even more dramatically by buying massive amounts of treasuries and mortgage-backed securities. So by doing that, because this is a supply and demand, like any market, it's a supply and demand, the Fed came into the market as the biggest buyer, which put a floor on rates, right? And so this is such a dramatic thing. And there's a lot of borrowers out there who've only experienced this new normal where rates are really low. People are thinking rates are high right now. And when I first got into business, if you could get under 6%, you were dancing in the street. So rates really aren't historically high right now. They're high in relation to our recent period of massive Fed intervention that we've normalized. And at some point, that's what we've been in the process of sort of unwinding that position, which has hurt rates by doing that. So the Fed went in massively into the market, particularly during COVID, and really transformed the market, right? People are now stuck in homes because they don't want to move because they've got a 3% mortgage. But it also inflated assets. So we've got this huge rise in housing prices, right? So we actually have a double the home appreciation rise in prices from the 1970s inflation era. Think about that. Twice as much as what happened in the 70s with that run on inflation. So wow. It's really important for folks to understand how abnormal the new normal is with Fed intervention. And hopefully there's going to be a day sometime soon where we're not worried about the Fed chair, what tie he wears at his press conference, because we've just been so dependent on the Fed for so long. We need to get back to a normal market, and that's going to be an interesting. We're in that path right now, we think, but consumers and the market have become very, very accustomed and dependent on the Fed bailing us out. So that's going to be a big question going forward around the world, not just here at home.
So that's not, is that sustainable with the Fed doing all this intervention the way they have? Long term, do you think that's a sustainable model?
it's not really sustainable. It's a little more sustainable for us because we're the reserve currency of the world with the largest military. So it does give us a little more benefit to, you know, we are, as they said during the financial crisis, we're the cleanest of the dirty shirts in the closet. The treasury market is still the number one place to put your money in a safe place, and around the world. But we have seen, and that is a current issue now, is particularly with the new administration's policy of how much foreign investment is going to be, you know, the attempt to displace us from being the reserve currency and the safe haven of the world. And that's really important for borrowers and consumers to understand how dependent we are on the attractiveness of our treasury market. Because if investors and central banks around the world don't buy our debt, which we're issuing a lot of, as I'm sure everyone's aware, that will have a profound effect on our interest rates on everything, but particularly mortgages.
So going back to our question we get asked every day, multiple times a day, what are rates? What are they going to do? David, I'd like to have you dust off your crystal ball a little bit. Give us an idea of what you would anticipate rates doing in the near future, maybe in the next 3 to 6 months, but also in the next 12 months or so. What do you expect the market to react and do?
Well, the market is expecting the Fed to cut 2 more times this year, and they have telegraphed that to some degree. However, we are seeing, I just got a report today that consumer prices are rising. And so it's really important to understand that the Fed is the only central bank in the world that has a dual mandate: stable employment and stable prices. And so that balance between the jobs market and keeping inflation on target is a very sticky, tricky thing for the Fed to navigate, particularly now that we're in an era where we haven't had inflation in any meaningful way for so long, and now we're above target. Their target is 2%, and they were wrong. If you remember, during COVID, they thought the key word was transitory, right?
Yes.
And their reputation for getting things right is very important to that institution, and so they're not going to be wrong again on inflation. So they're very, very focused on getting back to the 2% target. There is a lot of discussion that the 3% is going to be the new 2%. So we're in that period where, you know, what is the new normal now? Is 3% going to be the new 2%? That's certainly a discussion that's being had, but the Fed certainly isn't going to admit that yet. We'll have to see. But in the near term, I would say that I don't think rates are going to come down dramatically at all. The folks who are a lot smarter than me expect us to get into the 5s by the end of next year. And I think that's probably a reasonable trajectory. But I think we're going to kind of stick around in a more level way. We're going to move up and down a little bit, but I don't see a dramatic decrease in interest rates over the next in the near term. In the short term, I think we're going to again, as the Fed is still wrestling with this, and then there's been a lot of questions about how good is the jobs data? Can we believe it? And all these lagging indicators. And so that's and then in this post pandemic world, it has called into question, you know, the economic indicators that we rely on. You know, consumer behavior has changed dramatically. And as income inequality has grown, you know, if you look at who's really spending money in the economy, it's the top half of the consumer base. So these kinds of issues, along with the debt issue that we have massive debt here at home, but also around the world and the emerging economies, that global debt market could end up causing a real problem and getting in the way of what we expect is a gradual reduction in rate as the Fed kind of is going to embark on this kind of gradual, slowly unwinding to get to what they want to is get to a normal neutral rate so that they're not juicing the economy and they're not holding it back. And where that is, that balancing point is up for discussion. And there's a lot of big movement in the world. There's a lot of geopolitical issues in the world, whether it's war or if it's debt for all the central banks around the world. It's that will be that's a question mark. So, but that aside, assuming we don't have a bond market issue, we expect to see a gradual reduction in rates.
That's a big, yeah, geopolitical you're talking. I mean, worldwide, there's so much more influence than just what we see within our own borders. That's good to know. Now, Matt,
The bond market is a global bond market. Absolutely.
yeah,
His crystal ball is way better than ours.
yeah, mine's been broken for a long time. I think I threw it out. It was so broken. But Matt, let's pick on you for just a second. David, don't leave quite yet. We want one more question to ask you. But Matt, you've been patiently in the on deck circle here. Same
Yeah.
question to you. I mean, obviously you don't want to disagree with David. He's kind of the smartest guy we have, right? But
Well,
what do you think? What do you think is going to happen?
I agree with David, and I agree for a couple more reasons he probably elaborated too. Is we've got a big inventory issue in the United States. Like there's just not enough access to housing, especially in that mid to lower income space. And personally, I wouldn't be excited if we saw a massive drop in interest rates because there's not enough inventory to satiate demand. So we're going to see the sort of pent up population that's been renters and other things run out and try to buy. It's going to create competitive bidding where there's not enough inventory. It's going to take prices up. And then, David, don't let me quote this incorrectly, but I think the Fed's looking back at a 90 to 6 month look back, right? So when those payment numbers start hitting, when they bid up the prices, we're going to be in the same boat again. So I think, I don't want to give an endorsement to anybody on this, but I think Powell's done a really nice job doing the High Wire Act, and doing the balancing on this because, the economists at the Federal Reserve are largely historians. They go back and look at historic data. They have to interpret it. Then they have to look at current data. So I agree with David. We'll see some minor reduction in rate. We'll probably get into the fives. I don't think that's too far fetched. I think a lot of people that are holding out for these 4% interest rates are never going to see them, at least not in the near future, right? And I think that's an important conversation to have with our clients. I have it with our loan officers here all the time and a lot of our managers. And I think you got to look at the downstream effect of dropping rates significantly and what it's going to impact to inflation. Jobs are not getting much better. Regardless of reliability of the data, we've never seen a whole lot of data to support the jobs are massively improving. We don't see that wages are significantly going up and definitely not keeping pace with inflation. So, I think there's a lot to think about in that, but I think inventory is from where I sit, inventory is a big mitigator of that too, right? There's just not a lot of housing inventory out there, especially in the lower and mid space. So
that makes sense. And then David, real quick, 'cause I know you got to get off. One of the biggest questions that Kyle and I are asked day in, day out is always, should I wait? People talk rate and it's like, whether it be refinance or whether it be, that's a whole nother topic, but people that are on the fence about jumping in the purchase market, they talk to certain people on the streets and they think, oh, rate's going to come down. Should I wait? David, that's a real broad paintbrush for you to answer, but how would you answer that question if someone said, should I wait? After what you just said, David, what do you think the answer should be for folks like Kyle and myself or these people asking?
Well, for for a person who makes his living with dealing with interest rates, I would I would say that a home purchase is a life decision, and interest rate is one factor, but it's a small factor in the scheme of things. And you can always refinance. So I would say you really got to look at, and particularly at the market we have that Matt alluded to, where you have, in particular, if you're buying a home. It's hard to find a home that you want, that you can afford. And so if you can, buy it because someone else is probably going to get it from you. So, I would say in this market, rate is, you can always refinance. So I'd say, most folks are just trying to get the house that they want, where they want it for the price that they can afford. Interest rates certainly do have an effect on affordability, but as Matt discussed, I mean, we've had such an amazing, the new normal of price appreciation is, I mean, this kind of out of the world, how fast prices have grown, and you can't really point to any asset class that has just continued to rise and rise and rise the way that it has. I mean, in every asset right now is gold's over 4,000. The stock market's at all-time records. Of course, if you break down the details, right, you're going to see that it's that improvement in the stock market is concentrated in a very small amount of companies. So there is this sort of fragility to the market right now that we're seeing. And you know, and I always say, because bad news is good news in the bond market, right? That's kind of this strange phenomenon that we all deal with in the mortgage market, typically the relationship is when stocks do well, bonds do worse, and so bad economic news is good for rates, is generally how it works. But I always say you can't buy a house if you don't have a job, so be careful what you wish for there. So it'll be interesting to see where this shakes out, but we do need people employed and we do need wages to keep up with inflation, and the Fed does need to control inflation, and we need to solve the affordability problem, as Matt alluded to. I mean, there's just so much of the population that are locked out, and all this focus on Powell and the Fed to lower rates to help the mortgage or to help the housing market is really misplaced to some degree, because the Fannie and Freddie, and this is getting a little technical, but they have risk adjusters for different credit scores and different down payment options, right? And they've gotten very expensive to help pay for certain affordability issues. The Fannie and Freddie could just simply massively reduce those risk adjusters and instantly lower rates without the Fed doing a thing. So the Fed is a very indirect and obtuse kind of instrument. It's really pushing on a string to some degree. There's a lot of things that our federal government, through housing policy, zoning issues, to allow construction to happen, the right kind of construction. We have to support the construction industry. It's never recovered from the housing crisis of 2008. And we need internship programs. We need a massive subsidy probably to the construction industry, because they're only going to put their risk for the higher priced homes. We've got to build those lower priced starter homes. When my parents first got together back in the old days, it was a 750 square foot house with 3 kids in it. And of course, that's not acceptable to us now, but you get my point. We're not building starter homes for folks nearly enough. And if you see where construction's happening, it's in like 3 states, essentially, where the majority of housing and construction are happening. We really need a more broad-based, look at what we're doing with the CHIPS Acts and these other things that the government deems important to subsidize into, whether it's electric vehicles or whatever. We have a housing crisis right now, affordability crisis, and we really need a concerted effort on that. And rates are just one small part of it.
Well, we 100% agree with you. And we can't thank you enough, David, for your time. I know that your schedule is tight. And so if you do need to go, please know we're deeply appreciative of your time. We can't express to you, how valuable it is to have your expertise in our company, but also in our podcast.
Yeah.
And I know that a lot of people are going to learn a lot of great things about how, that they're pulling back the curtain a little bit here to show people and help them understand a little bit. And that's what our whole ambition is with this podcast, is to help the average Joe understand of what it is to have a mortgage, why the market is the way it is, and how we can help them. But certainly appreciate your time. You're fantastic, and we're grateful for you.
Yeah, thank you, David.
Happy to be here. Take care.
Thanks, David.
Matt, don't you leave yet. We're going to pick on you. See you, David.
Hey, I don't mind it. It's an honor to work with guys as smart as David. So,
so Matt, to kind of segue from what David just explained to us, he mentioned a housing pricing crisis and what that's looking like for us. Dave and I constantly talk about, if rates are lower, that can make an adjustment in payment.
Yeah.
But really, that dramatic adjustment comes with a lower house price, not a 0.25% off your interest rate. Yeah. And so, what do you anticipate the housing market to do with what we have currently?
Oh, that's a loaded question.
That's a lot to throw at you. Yeah.
Yeah, because kind of to David's earlier point, and I think in simple terms, it's if you find a house you can afford right now, right, you buy it. You fix the price at least, so you know exactly what the debt service is. At least the amount you're financing and what you're paying for the house. And it's not always the case, but houses have historically appreciated, right? We haven't seen a lot of negative, we haven't seen a lot of depreciation except for 2008 in some select markets. So then that's where you kind of have to have a convergence point, of like, hey, if I'm waiting for rates to go down a point, but I know the average appreciation in this neighborhood I'm looking in, or school district or whatever, is 3.5%. Well, sit down with a professional and do the math.
Yeah.
right? And, hey, if I'm holding out for a 0.5%, I don't want to buy yet, but prices keep going and going up 2.5, 3.5%, whatever the number is. Do the math, and what does that turn into? And the one thing is, you're pretty much guaranteed because you can pull historic data to see what the appreciation of a property is. You can go back and look at the average appreciation areas. Most of your association of realtors have that data readily available in each state and every market. The St. Louis Federal Reserve has a lot of that data available too, where you can look at average prices by MSA. So they do a beautiful job of getting historic data out there for people to read, and it's public. You don't have to, you can go and look at it. Yeah. But then you do the math, and if you have no guarantee that rates are going to drop 0.5%. David's point, bad news drives the bond market. Well, conversely, there could be things that drive it the opposite way. Right. Yeah. We start seeing, crazy growth in jobs, inflation starts getting out of control. So we have to raise rates. There's a lot of variables you really don't know. And so I always think that's the best advice I give people. It's like, hey, if you find a house and it's within your budget, don't stretch, don't put yourself in harm's way to buy something. Don't put yourself at risk to default. But you need to secure the price and the property. When it comes to the housing market, I very rarely advocate for government intervention. Usually when the government gets involved, it gets messy, right? There's some inefficiencies there. But we need more incentives for first-time home buyers. We need more incentives for people to maybe upgrade. I remember, post the crash, they had the tax incentive. I think it was like $15,000, to be a first-time home buyer. And by definition, it was you couldn't have owned a house for 3 years or something like that. It wasn't your very first house. I think we need to see some of those incentives. I don't think, and I forget what the number was, so I might be off on this quote, but I think it was 60 some odd percent of Americans are in sub 4.5% interest rates, right? That own property. So you're not going to see a lot of people, kind of move per se, and I don't think you can do much to augment their interest rates. But if we're in the fives, you're 1.5 off. But pricing's the real problem, right? So we need more building, we need more inventory. We probably need to protect consumer inventory from institutional investors that are able to come in and turn to rentals. We saw a lot of that during COVID. But yeah, that's I see in some markets where there's job growth that they're starting to do that. A lot of cities, a lot of counties are investing, on states are trying to incentivize. Federal government, I think, is talked about doing a lot of things, but I haven't seen a whole lot go through.
One thing that has been really beneficial in our area is that we have our state or Utah housing, and there is a pretty substantial down payment assistance. Mm-hmm. Got to be careful not to say grant, because it's certainly not a grant. Unless you're with law enforcement, then that is a grant up to $25,000. But I know that there are some programs out there to help us better help those that are trying to enter the housing market, give them as much leg up as we possibly can. And so we're lucky to be able to be in an area that does do a little bit of that. I wish there was more incentives, because that would be powerful.
Yeah, I think that the challenge, obviously, it's always mathematics. I mean, really, that's what we're dealing with right here is mathematics. You have the home price, the loan amount, and the interest rate. Those two calculated in this formula spit out basically what your monthly payment's going to be.
Yeah.
And everything comes down to budget and what the household can afford. It's just like what you said. I do believe that supply demand historically has been a big part of this. And so really, to go along with what you just said, inventory is key, right? I mean, if we can get the inventory, like new homes built, or if rates did, I think where rates dropping would help things more than anything is it would get those people off the fence that are holding on to their homes and not relocating because they're married to that rate that they've been married to since 2021, 2022.
Agreed.
And until those people actually let loose and maybe go buy that house across town that they want, they're not doing it because those golden rate handcuffs have been on them for so long. Until that happens, we're relying, like you said, really relying on the builders to build the inventory, and they just can't do it at the right pace. But hopefully, me personally, this is me talking now, hopefully we see people start to unload some of those houses if rates start to come down, and we get some of that organic, natural inventory in there with the new builds. And then we see some supply demand driven things that start to drop some of these home prices, because I do the exercise. I've talked about it before on some of these podcasts. You can sit there and sit with a borrower and tell them, ask them what their what they're comfortable paying, and they'll tell you what it is, and I'll even put 0 as an interest rate. And based on the home prices that are out there, even at 0% interest, which we can't offer, that's not anything that's ever offered, it still exceeds what they can afford. So really, I think we need this to happen. I think we need some sort of softening in order to get more of these, especially these young couples. And that's what we deal with all the time with these young couples that really want to get in the game. You know, it used to be we would see people between 20 and 25 buy their first home. And now we're sitting here, we're seeing people between, it's become, I don't know what the average, I think there's some, you
It's like
probably
30, 31, I think, or 30. I forget what it was. It was something in the mid. It was a shocking number though, because like the average first time home buyer is like 37. I'm somewhere approximate in there, but it was significantly older than what we experienced, especially when I first started in the industry, right? It was just a night and day shock. And I think there's two things there. I think, home prices matter, but I also think with inflation where it's been savings, right? And
Yeah.
so, we see a lot of, I still have a lot of people just reach out, want my opinion, or, old partners, builders, clients, things like that'll call and just say, hey, what do you think? And they might refer someone over that has questions about they want to buy a house. And you start talking and they get married to old norms like, well, I don't want mortgage insurance. Well, why not? Well, I'm going to save up the payment. Well, what's the average price in your area? Oh, it's $400,000. So you're going to save $100,000 to buy a house. Well, no, but maybe 25. Okay, maybe you should. And really the idea is like, hey, sit down and do the math.
Yeah.
Work out the budget. And if it doesn't work for you, it doesn't work for you, right? That's okay. But if if you start getting these old norms of, well, I'm going to save because of mortgage insurance. Well, what's your interest rate, at this credit score with this down payment versus going through FHA and having putting 5% or whatever you want to put, but maybe less, using some of what you're trying to save to get rid of other debt, right? And then because your checking account doesn't care where the payments go. It's just a dollars in, dollars out, right? And so ultimately you have income and you have expenses. And if you work with the right people and they take the time to walk you through it, you can kind of work into a solution that makes sense. But you see a lot of people, and you know what? For a lot of people, they just don't know a lot about it, right? And so it's incumbent upon us to educate people, and give them good information, but also tell them, hey, this isn't great. This isn't something that's going to work out well for you if you do it, right? It's not what can you buy, it's what should you buy, and how much should you pay. So,
but one thing you mentioned, and Dave and I have a number of customers that are like, yeah, I'm going to save for a long, long time. What interest rate do we get at a bank anymore? I mean, it's like 0.047.
Yeah, and the savings account.
0.00. Yeah, I mean, it's
0.5% maybe.
Yeah, I mean, 0.5% would be awesome. Yeah, a lot of these places. But you mentioned earlier, the typical appreciation that we've experienced is 3 to 4%, 3 to 5%. If people are really running the math and doing the numbers, instead of locking that cash away and making 0.5% on a good day, let's get them in a home, use the cash that they have, and get some appreciation while they're paying down their mortgage. That way they're gaining on their asset, they're paying their debt down, and they can refinance or just drop that mortgage insurance when they're there. And I mean, they're building wealth and equity while they're saving at that point and at a greater rate.
I think the thing to take away there, and that's a great point, Kyle, is that we're dealing with now what used to just be, hey, prices are low and rates are good. That young couple, let's get you in and get you that low payment immediately.
Yeah.
Maybe it's not something we can do immediately. Maybe it's something that, there's some buy downs and some things we can do to get you close, but let's watch things like you just said, as equity builds, as rates do come down, strategically refinance and do the different things that we can over time. It might be a two-step process to be able to get them into a payment that's really where it needs to be. And that's just a matter of buy now, refi later, marry the house, not the rate. Is that what they call it?
Yeah. Yeah.
Yeah. And I mean, you're effectively just restructuring the debt, but you're at least securing the buy price, right? And then as long as you set an appropriate budget and you're disciplined, and that's the one thing, all these things always boil down to being disciplined, right? Creating a budget. This is my outgoing. And then, working, with your loan officer to come back and, watch the rate market, we kind of say, hey, if we close at 6.5 and we know this is sort of our budget, what we're spending, what we're saving, and how we're working through our debt, and kind of the optimal point for us to restructure the loan is when it's at 5.75. right? And the good professionals, they pay attention to that. They work with their clients. They don't just engage them after the first transaction. Our team here does a great job of following up for years, right? And at key points and checking with their clients. And that's what the professionals do. And the idea is it's a long-term debt. It's mostly a 30-year debt for most people, right? Does everybody keep that loan for 30 years? No, but usually 7 to 10 years, is probably par for the course, at least in my experience. It's probably changing now that we've had higher interest rates for a little bit longer. But, in the grand scheme of things, we don't even have what we consider to be high interest rates.
Yeah,
We have fairly average interest rates. But is the key point, and I probably belabor this too much, but it's the housing prices, right? So that requires some careful and strategically planned budgeting, if you want to be in the housing market, right? And that's where I think that's mission critical. When every friends, kids that come to me, nieces and nephews that ask what they should do, that's the first thing I say: sit down and get a budget, right? Don't get too married to any crazy financial concept. Don't watch YouTube videos where they're telling you to do this stuff and, just crazy. But just sit down and just create a good disciplined budget. This is how much I make. This is, where I know my income is always going to be, right? Don't budget for the raise next year that you're not sure you're going to get. Don't budget for that bonus that might go away. But this is what I can afford. And this is all my outgoing. And even if you have a credit card, or, some sort of fixed debt shorter term, what's the value of getting rid of that first so that you have more freed up to make more payment for an appreciating asset, right? It's not the idea of like financing a credit card for 30 years. So there's a lot of malpractice out there, but it's the overall debt structure that makes a huge amount of difference.
Well, we certainly hope they watch this YouTube channel, but
Yeah.
But you said two words that I love: budget and discipline, which are kind of unpopular words in our society right now.
Yeah.
But honestly, those two things alone will help a lot of people get in their homes.
Yeah, for sure. And I like one other thing you said there. You talked about the average age, because we were talking about this a number of times. But it did used to be the early 20s, mid 20s was the average age to jump in the market. And now you're saying around 30 to 31. We're kind of fortunate right now. We have, you think about our target audience when we have a podcast like this. He's sitting right here behind us. His name is Logan. He actually is our video. He's our editor. He's our guy that does this whole thing, and it's
That's a
awesome.
good job.
He's like a sponge here. He soaks this stuff up because he's learning. He wants to be that first time home buyer, and we talk about this as we clean up after each podcast. And I think it's really kind of cool that he's a perfect target audience. He's listening to you guys, and he's learning so much from this because I know he wants to get in the market, and it's hard when it's like it doesn't make sense yet fiscally, or if he's got to bite off a bigger amount than he really wants to. But that's, like you said, I like that. Discipline and responsibility and really understanding and having a plan. That's what it's all about right now.
Yeah, don't stretch further than you need to, right? I look, it's always, every generation's gonna go, man, it was easier when we were kids, right? It was much easier.
Yeah.
I think the last car I bought cost more than my parents' first house, right? It's just part of things, right? And it's unfortunate, but I do think it all starts with budgeting, sitting down. These are my financial goals. This is what I want to do. And this is what I have to work with. Just like how we plan in business, right? This is our objective. This is the resources we have available to us. And this is how we're going to go about doing it. And I think people taking that approach would be very successful in this market. As competitive as it is, I think they're going to be able to, find housing. I do think we'll see some inventory pick up over time. There's just such a demand. It's at first it became something you kind of raised an eyebrow and you're like, oh, like that's not great. And after a while you're like, wow, this just keeps getting worse and worse and worse. And then you start looking at rents. And two things I do when I go to any new market that we're looking at, growing or just, doing more business in or just curious about it. I look at the average home price. I pull the Fed data, from the St. Louis Fed. I look at, kind of the sales numbers, but I also look at the average rent. I'll go to Zillow and just pull up houses for rent. And they go to how much inventory is there and how much is it. And there were markets that, 3-4 years ago, the average rent was $1,200 for a 2-bedroom, apartment, right? Now you're looking at $2,400-$2,700. And that kind of tells me that's a housing market that both needs inventory. It'd be it's probably a little price sensitive, right? And there's just a lot of indicators out there that we need more inventory. And I think action's always slow to follow, but I think we'll start seeing some action. And we're focused on, as a lender, we're looking at where we can create inventory, working with, different firms that are trying to do modular prefabs and create, a little bit quicker, lower cost inventory. And so it's part of what my team does is we sit there and think about those things and then reach out and look at that. But yeah, it's going to be an interesting couple of years, to say the least. So.
Excellent. Well, Matt, we can't thank you enough for your time. Last little piece of advice you'd give to our listeners, particularly, those first-time home buyers. What would your elevator speech be to these that are looking to buy in the next 12 months?
Well, it's not impossible, in fact, it should be a positive experience, right? You're buying a home. This is where you're going to live. It's also a necessity for most people, right? So consider it as such. Learn to compromise on certain properties. You're not going to find everything perfect, but you'll find properties that make sense that you can make changes to. Once you own it, you're able to renovate, you're able to do a lot of different creative things. But the big thing I will say is get expertise, right? It doesn't cost you anything, to go to someone that knows what they're doing. There's great loan officers in the business. There's great realtors in the business, and work with people you trust that, aren't just pushing you to sign a contract, aren't just pushing you to move forward with a loan. They're going to take time, walking you through it, do the budget. I look at that even in my career when I first started. I didn't know much about mortgages, to be honest with you, and there were people that were kind enough to teach me how it all worked, right? And then when I bought my first house before then, I didn't know the first thing about it. And then when I actually started working in the business, I came back and knew a lot and was lucky enough to work with a lot of realtor partners and a lot of people, they're industry professionals that just taught me so much. And I've always tried to pay that forward in my career, and with everybody I interact with, hey, let's sit down and work out a budget. Let's talk through these things. Let's do all those things. And, it's got a lot of value. So that's my advice. Seek expertise. Don't get discouraged. New houses enter the market every day as much as they do leave the market, right? So if you don't find it Tuesday, Wednesday, that gem might pop up. And so it's best to be working with professionals, have your budget set, be ready to be disciplined in what you're going to buy, and have your eyes open to look for it and work with someone that's going to guide you through it.
Excellent. Thank you so much. This is a highly anticipated podcast we've been trying to put together for quite a while. I can't thank you enough for your time. What a great combination it was to have you and David with us to be able to give us both sides, both the marketing and the strategic aspect. And can't thank you enough. But this is the Mortgage Guys podcast. We're excited to be able to help people own homes. If you have any questions, look us up. We'd be happy to help. Thank you very much.
Thanks for having us, guys.